Hello everyone and welcome to this episode. Tonight at 8:30, the US July CPI will be released. The market currently expects headline CPI year over year to fall from 3.5% to 3.4% and core CPI to fall from 2.6% to 2.5%. Will CPI come in above expectations or below expectations? What we truly need to focus on is how capital will be redistributed after the CPI data is released. What it really affects is the shift between two types of trades. One is called the rate cut trade, where capital buys technology, growth, and future cash flows. The other is called the recession trade, where capital worries about economic weakness, starts buying defensives and cash flow assets, and avoids banks and cyclical stocks. That is why, when we discuss CPI expectations, we should not treat CPI as a simple inflation number. It affects interest rates, valuations, profit margins, and credit risk at the same time. Now let's break this down clearly. First, why is low CPI positive for technology stocks? Technology stocks, especially AI, cloud computing, semiconductors, and high valuation software companies, are essentially long duration assets. A large part of their value does not come from how much they earn today, but from expected cash flows over the next 5 years, 10 years, or even longer. When the market buys Microsoft, NVDA, Amazon, and Google, it is not only buying current profits, it is buying the long-term growth brought by future AI, cloud computing, software ecosystems, and data center expansion. The question is, how much is future money worth today? That depends on the discount rate. The higher the discount rate, the lower the present value of future cash flows. The lower the discount rate, the more valuable those future cash flows become. So when CPI comes in below expectations, it means inflation pressure is easing. When inflation pressure eases, the need for the Federal Reserve to keep raising interest rates declines. When the probability of further rate hikes declines, pressure on long-term treasury yields and real rates also falls. When the discount rate falls, valuation pressure on high valuation technology stocks eases. This is why technology stocks often react first after low inflation data is released. The market becomes willing to use a lower interest rate to reprice future growth. For AI technology stocks in particular, the biggest pressure over the past period has come from two market concerns. First, interest rates are too high, making high valuation assets vulnerable to compression. Second, AI capital expenditure is too large, and short-term free cash flow may be consumed. If CPI continues to cool tonight, at least the first pressure will be clearly relieved. The market may once again be willing to pay a valuation premium for AI, cloud computing, semiconductors, and high valuation software. Second, why is low CPI not necessarily positive for bank stocks? How do banks make money? One of their core sources of profit is net interest income. In other words, banks take in deposits at a lower cost and lend at higher interest rates, and the difference in between is the net interest margin. But when CPI falls and the market starts betting on rate cuts, banks face a different chain of logic. Low CPI brings stronger expectations for rate cuts. As rate cut expectations rise, loan yields may move lower. Returns on newly issued loans and floating rate assets decline. Bank net interest margins come under pressure. Bank stocks do not necessarily benefit. BAC is a typical example. Bank of America's second quarter net interest income grew year over year, but the company also noted that lower interest rates partly offset net interest income. What does this tell us? It shows that even if BAC's current earnings are not weak, once interest rates start turning lower, the future upside in net interest margin may be constrained. For banks, the most ideal environment is not a rapid decline in interest rates. It is an economy that remains healthy, stable credit quality, and interest rates staying at a relatively favorable level. In other words, technology stocks prefer falling interest rates, while bank stocks prefer economic stability, healthy spreads, and no increase in bad loans. This is why the same CPI data can have completely opposite effects on technology stocks and bank stocks. There is also a very important background for tonight's CPI. It comes after employment data has already weakened noticeably. When employment weakens, consumption cools, and corporate cash flow pressure rises, the market begins to worry about something else. Inflation may be falling not because supply has improved, but because demand has weakened. At that point, the market's trading focus shifts from will inflation fall to will the economy deteriorate. This is also why we need to mention bank stocks when discussing CPI. Bank stocks are not a side character in this topic. They are a key indicator for judging whether the market is trading the benefit of rate cuts or trading economic recession. If CPI comes in below expectations, technology stocks rise, and bank stocks also remain stable, it means the market is more inclined to believe in a soft landing. If CPI comes in below expectations and technology stocks rise first, but bank stocks, cyclical stocks, and consumer finance stocks weaken, it means the market is starting to worry about economic weakness. When the market begins to worry about economic weakness, capital will not simply choose between technology and banks. It will look for a third exit, which is defensive sectors. Defensive sectors include utilities, healthcare, consumer staples, insurance, and some high cash flow assets. The common characteristics of these sectors are that their earnings are less sensitive to the economic cycle, their cash flows are more stable, and their demand is more inelastic. Healthy low CPI is positive for technology stocks and can also support risk appetite. Recession-style low CPI may allow technology stocks to rise first, but afterward, capital will gradually flow toward defensive and cash flow assets. Based on the underlying logic above, we can identify 3 stocks that may benefit and deserve continued attention. The first is Microsoft. Microsoft is one of the cleanest beneficiaries in a low CPI environment. It has 3 characteristics at the same time: high quality cash flow, clear AI infrastructure visibility, and a valuation that is sensitive to interest rates. If CPI is moderate and market concerns about rising long-term interest rates decline, Microsoft's valuation pressure will ease. At the same time, Microsoft's AI infrastructure has not contracted, and Azure continues to expand. The second is NVIDIA. NVIDIA is one of the core assets with the highest beta in the AI capital expenditure chain. If CPI comes in below expectations and market risk appetite recovers, high valuation AI assets will regain pricing flexibility. Lower interest rates are not only positive for NVIDIA's own valuation, but also help cloud companies continue to maintain high capital expenditure. But NVIDIA is not a low volatility defensive stock. It is a high beta asset. The condition for its upside is that the market continues to believe AI orders and cloud companies' capital expenditure will not be revised downward. The third is Amazon. Amazon's path to benefiting is more complex. First, low CPI lowers the discount rate, which is positive for the valuation of AWS and AI cloud businesses. Second, low inflation can ease pressure on consumers, which is positive for e-commerce and advertising businesses. Third, if oil prices and logistics costs do not continue to rise, Amazon's retail margins may also receive support. The significance of tonight's CPI lies in which main theme the stock market ultimately chooses. If capital buys technology, banks do not weaken, and the credit market remains stable, then the rate cut trade is dominant. If technology stocks rise first, but bank stocks weaken and defensive sectors strengthen, then investors need to be alert that the market is trading economic weakness. Before making any moves in your own portfolio, you first need to see clearly whether capital is buying rate cuts or hiding from recession. In other words, direction comes before selection, and it is more important.